Hello and welcome to the second of our How to Become Wealthy in Real Estate the Smart Way training series, where we'll be discussing our 2-year buy, hold, and flip strategy. But before you continue, we must tell you that this strategy uses elements of both short-term fix and flip projects as well as elements of our long-term buy and hold investment strategies discussed in part 1 of this training series, especially when it comes to leveraging. So if you haven't already done so, we highly recommend that you take the time to view our previous Strategy 1 video, Building Your Real Estate Investment Portfolio Long Term, before continuing on with this presentation. Having said that, let's start this session by taking a look at what most would consider to be a typical successful fix and flip project, which means the project actually produced a profit. Again, we're going to be using nice round numbers to keep things simple. So you purchase a property for $200,000. You then spend $40,000 fixing it up to get it ready for resale. You sell that property for $300,000 minus listing fees and closing costs of somewhere in the neighborhood of around $20,000, which leaves you $40,000 before taking into consideration short-term capital gains taxes. Now we have to tell you here, this is just a quick disclaimer, we're not tax experts and we are not giving you tax advice. But what we can say is that at the time of this recording, short-term capital gains are taxed at the same rate as ordinary income, which means you'll pay the same tax rate on investments held for less than a year and a day. So, for demonstration purposes, let's pick a middle-of-the-road tax bracket of 28%, which would be $11,200 payable to the IRS in this scenario. Now this doesn't include state and local taxes, and in this scenario, you would net approximately $28,800, which would be a whopping 11% return on your $260,000 investment. Of course, this scenario only applies if you were able to pay all cash for the property and to make the necessary repairs. Obviously, if you took out a hard money loan, your ROI would be substantially less, depending on how long you had to hold on to the property before the flip. We understand that our fix and flip approach may seem to fly in the face of what most get-rich-quick flipping real estate gurus have to say, but pay close attention here, because in the next few minutes, you will learn how to minimize your risk and substantially increase your return on your real estate investments by using our Smart Map to locate and research profitable real estate deals that already have existing equity, leveraging your liquid capital, securing a low-interest amortized loan instead of using hard money, while substantially reducing your capital gains tax liability. So without further ado, let's jump right into our Smart Map Investor Report on a property we located on the multiple listing service. To ensure we're using good comparables to the subject property, we've already taken a good look at and further examined those we've selected. We've also taken a good look at the comparable rental properties selected as well. We then simply click the Calc button, which brings us to our investor report. Helping you to read and understand the data in this report is where we'll be spending the remainder of our time for this section of our training. On a side note, if you don't know how to use our Smart Map to create your own unlimited investor reports and CMAs, please be sure to visit theequityfinders.com and click Smart Map at the top of the page to view our extensive training video. As you can see, this property is listed for $195,000. But we can also see the average ARV, or after repair value, is $238,264, and that the highest ARV is $247,175. The average ARV is determined by using the adjusted price per square foot of the selected 3 or more comparable properties, while the highest ARV is determined by simply multiplying the subject property's square footage by the highest comparable's price per square foot. So just to keep things practical, we're going to go ahead and stick with our first set of numbers and use the average ARV, which shows a spread of $43,264 or 18.16%. Which means that if you were to make a full price offer and purchase this house, you would already be ahead of the game with approximately $43,264 in potential equity. And if one were looking to quickly fix and flip this house, you would obviously have to use part of that equity spread to make any necessary repairs to bring the home up to par with the highest and best comparables. This would of course cut into your net profits of $30,755 after your resale costs. Not such a great margin when you look at it that way. So again, keeping things practical, you would probably not even make a full price offer on this property. But you might consider offering 10% under the asking price, or $175,500, which would be a reasonable offer the seller would probably not be offended by, might entertain, and would probably have a pretty good chance of being accepted. So let's go ahead and change the suggested offer price to $175,500, which brings our net after resale costs up to $50,255 or 21.09%. Please remember, this is not how much you would actually profit by simply purchasing and reselling this home. What it does show you is how much potential equity is in the property to be used for acquisition costs, to pay for any necessary repairs, to cover your carrying costs, as well as cover your short-term capital gains tax. We'll go ahead and let you crunch the numbers on this to decide if it would be a good short-term fix and flip project for you. Because now we're going to be focusing on the annual rate of return on investment information, because this is where it really gets exciting as we get into the crux of our 2-year buy and hold to fix and flip strategy. So let's start by taking a look at the buy and rent data in the right-hand column. As you can see, if you were to pay all cash for this property and put in just enough work to bring it up to rentable condition, if necessary, your annual rate of return on your investment, including rent, 6% yearly appreciation, and just 25% of the existing equity spread would be approximately $41,062, or 23.4%. Not a bad return, but how long would it actually take you to recoup your initial investment of $175,000 from just the rental income of approximately $14,000 per year before taxes? Right, at least 12 years, possibly more. But watch what happens when you put just 20% down and finance the remaining 80% at a rate of 4.5% interest, and do a side-by-side comparison. With all things being equal, except your initial investment of only $35,000 instead of $175,000, as you can see, the annual rate of return on your investment for rents only jumps from 8.09% all the way up to 16.14%. Rents, including annual appreciation of 6%, goes from 16.24% to 56.87%. And when we add just 25% of your existing equity spread, we go from an annual ROI of 23.4% all the way up to 92.67%. Now, if these numbers don't impress you, we honestly don't know what will, but there's actually more. We understand what you may be thinking to yourself right now, in that this is all well and good, but how do I get rich quick flipping houses? I don't want to be a landlord, I don't want to get calls in the middle of the night about a leaky toilet, and I certainly don't want to put a bunch of money into repairs just to have a bad tenant destroy my property. But remember, our philosophy and approach to helping you become wealthy in real estate the smart way is to teach you how to get rich slow, but for sure. And if you continue watching and listening, you'll soon find that we have addressed all of these issues and hopefully put your mind at ease. So before we continue, I want to refer back to what I said earlier about putting in just enough work to bring the property up to rentable condition if necessary. The if necessary part was not a mistake. You see, our Smart Map technology helps you to locate and research properties with existing equity, whether they need work or not. Again, if you have not watched the Smart Map training video at theequityfinders.com, I highly recommend you do so right away. Because our data is pulled directly from the MLS each and every day, you have access to all of the listing details and all the images of the subject property in its current condition. And the same detailed information is available for all of the comparable properties as well. Point being is that in many cases, the subject property has already been updated or remodeled, which means very little work, if any, may need to be done at all. In other words, you can easily locate properties that are already in rentable or near rent-ready condition, thereby eliminating the fix part of the fix and flip equation for now. And who gets that existing equity, which we like to call magic-free money? Right, you do. So let's take a closer look at our subject property, for example. As you can see, this property appears to be in pretty good shape and is probably move-in ready as is. But if you wanted to fix and flip this property in order to make a quick profit, I'm sure we would both agree that you would more than likely have to do a complete remodel in order to bring the property up to par with the higher comparables after repair value. And once again, unless you're fortunate enough to be sitting on a pile of cash, you would probably have to take out a hard money loan and be prepared to deal with those high carrying costs. Not to mention the short-term capital gains tax liability we touched on earlier. So this is where we recommend you exercise just a little bit of patience and take things one step at a time, as we show you how to squeeze every bit of profit from this property in a relatively short period of time by following our 2-year plan. Step 1, instead of paying all cash or taking out a high-interest short-term hard money loan, we would suggest putting 20% down and financing the remaining 80%. We work with some great conventional lenders who have some of the best loan programs for investors with low interest rates averaging 4.5% for 30 years. Step 2, put the least amount of time and money possible into any necessary cleanup and repairs to get the house ready to rent. Again, we want to emphasize the fact that this may not even be necessary depending on the existing condition of the home. And step 3, you guessed it, rent or lease the property out for at least 1 year, preferably 2. You'll know why we suggest holding the property for 2 years in just a few minutes. If you don't want to be a landlord, quite frankly, we don't blame you, which is why if you take a look at the yearly expenses section of our investor report, we have already included property management as one of those expenses. And for a measly $89 a month, Renters Warehouse of Phoenix will provide the following services so you don't have to: tenant placement, rent collection, inspections, tax and licensing paperwork, maintenance coordination, and much more. And in many cases, they can have the property rented for you before you even close. You'll also notice that we've taken the liberty of adding a maintenance warranty plan to the yearly expenses. Obviously, here in Phoenix, the biggest expenses, should problems arise, are the roof, air conditioning systems, and the pool equipment if you have a pool. So it goes without saying, we highly recommend you do a bit of research and acquire a home warranty plan to protect your investment. And with returns like these, you can certainly afford to have someone else manage and maintain your investment properties. After all, if you have stocks, bonds, or a mutual fund, you certainly have a professional managing that for you. So why wouldn't you hire a professional to manage your real estate investments as well? Now let's talk about why we feel this is the smart way to become wealthy in real estate and what it can mean for you in dollars and cents. Instead of paying all cash or taking out a hard money loan, you've only used $35,100 of your own money to purchase this property. By simply renting out or having your property management company rent out the property for 2 years, your tenant is paying down your mortgage while your property continues to appreciate in value. As you can see, we are using a conservative appreciation rate of just 6%, but here in the Valley, we have been seeing appreciation rates as high as 9 to 10% in the past few years. In addition, you have also drastically cut your capital gains tax liability, which means more money in your pocket when it comes time to resell the property. Why? Because long-term capital gains, those that apply to investments held for at least a year and a day, are taxed at a lower rate than short-term gains. Again, we are not tax experts, and we suggest you contact your tax advisor with your specific tax questions. And finally, if your annual rate of return on rents, yearly appreciation, and just 25% of your existing equity spread is 92.67% in the first year, what will the estimated return look like after 2 years? Right, double that. In other words, 185.34% ROI in just 2 years. And just by adding the appreciation to the existing average repair value of $238,264 in just 2 short years, this property will potentially have an ARV of $267,713 or more. And now it would be a most excellent time for you to put that existing equity or magic-free money to use to completely remodel and put the property back on the market. Now there are several ways to turn the equity in your home into cash. Many investors use what are called bridge loans, which is definitely a viable option. But we would highly recommend taking out a home equity line of credit, as bridge loans usually have higher interest rates and points attached. Or, who knows, you may decide just to keep it as a rental. The choice is yours. Either way, here at the Equity Finders, we think this is the smart way for you to become wealthy in real estate. Oh yeah, one more thing before we wrap this up. I'm sure you've already thought of this, but just in case you haven't, the most important takeaway you should get from this training is that successful real estate investing is all about leveraging your available funds in order to get the highest return on your real estate investment. And in this scenario, just remember that that same $175,000 we spoke about earlier could be used to purchase just one house, or you could leverage that same $175,000 to purchase 2, 3, or more buy and hold to fix and flip properties, all appreciating and increasing in value over a short 2-year period as your tenants pay down the mortgages and cover all of your carrying costs, including property management, which can mean a nearly hands-off approach for you. So the question you should be asking yourself right now is, do I have the patience to take things one step at a time and become wealthy in real estate the smart way? If the answer is yes, we'd like to work together with you to put together a long-term real estate investment strategy for you. So be sure to pick up the phone and give us a call at your earliest possible convenience to schedule an appointment. Complete contact information can be found on our website at www.theequityfinders.com. In our next training session, we will be building upon these lessons to take this 2-year plan to a higher level of earning, as we discuss how our SmartMap technology can help you to predetermine whether or not a simple addition will double or even triple each dollar you spend. So stay tuned to your email inbox for our next lesson on how to become wealthy in real estate the smart way. Thank you once again for viewing and listening.